Hello. Thanks so much for taking the time to join me today. My name is Jennifer Swain, and I'm a financial literacy trainer at Access Credit Union. Access Credit Union implemented a financial literacy program in 2017 called Each One Teach One. This program was created by Vancity Credit Union in 2008 and is an award-winning program that offers workshops to educate members of the community on basic financial skills. I'd like to assure you that there is no selling of any products or services during our presentation. At Access Credit Union, we currently have 21 staff members trained to facilitate our workshops, and I'm very happy to be bringing you our loans, cost and obligation workshop today. Today we are going to discuss how to decide what kind of loan is best for your needs, how to understand payment terms and obligations, how interest is calculated and why it matters, and much more. Before we talk about costs and obligations of loans, we must first discuss financially sound reasons to borrow money in the first place. Credit has both advantages and disadvantages. By using credit wisely, we can benefit from the advantages and reduce the disadvantages. While there are many reasons to borrow money, and certainly many reasons we may find ourselves in need of money, there are, financially speaking, only a few financially sound reasons to borrow money. First, to make an investment. This can include buying a residence or rental property, to pursue higher education, to purchase tools, equipment, or a vehicle for a job, invest in your retirement by investing in an RSP, or investing for higher returns. Second, to reduce interest payments you are currently making or to simplify your payments. This is generally seen in a consolidation loan, which we will go into more detail on later in the presentation. And lastly, to build a credit history. We have overviewed the financially sound reasons to borrow money. We are now going to look at the other side, financially challenging reasons to borrow money. Just as there are good reasons to borrow money, there are also times when borrowing money is not a good idea for your long-term financial health. It generally is not a good idea to borrow money for the following reasons: to engage in uncontrolled spending. If you need to borrow money on your credit card to buy a consumer good that are not needs, like a new TV, you may find yourself in a difficult financial situation. Before you borrow money to buy consumer goods, consider your wants versus your needs. To pay monthly bills. If you aren't able to cover your monthly obligations, borrowing more money will put you in a more difficult position as each month passes, unless you reduce your bills and adjust your budget. To pay outstanding debt. If you are struggling to pay your existing loans, borrowing more money can easily put you in an even worse situation. There is one exception to this rule, which we will talk about in a few minutes: the consolidation loan. To borrow money for someone else. It's one thing to co-sign a loan, but you should never borrow money for someone else. If that person is unable to pay you back or decides they simply don't want to, you will be left to make payments on a loan you might not be able to afford. And lastly, to make a risky investment. If someone has a deal that they guarantee will make you money, be very careful. Borrowing money to invest, even in the stock market, can be very risky. We have now looked at good reasons and not so good reasons to borrow money. But what requirements do financial institutions have to gain access to credit? Each financial institution has similar but differing requirements you will have to meet in order to qualify for a loan. In some instances, a lender may require that you simply provide proof of employment, evidence of appropriate collateral, which is often property, and/or both. However, all lenders will have these same minimum requirements: a good credit history, proof of source of income in the form of a letter of employment, pay stubs, rental agreement, and/or proof of pension, Canada Revenue Agency notice of assessment. You will partake in interviews that go into your assets and liabilities, as well as your income and expenses, and collateral. Collateral is something that is pledged as security for repayment of a loan and is to be forfeited in the event of default. Some additional things to consider are: when you meet with your lender, be prepared to answer many questions that deal with your finances. The more they know, the more they will be able to assist you and recommend the best product or service to meet your needs. You may also be asked to come back with additional information, such as additional forms of verification of income. Any additional information your lender asks for helps to provide them with additional support and verification that you are able to take on the debt you are asking for. When you are borrowing money, there are some important things you need to consider. Just as everyone's financial needs are different, every loan is different as well. So it's important to remember that when you are offered a loan, to read all the details carefully to make sure the loan is right for you. To determine whether a loan is the right one, you should answer the 5 following questions. What payment is comfortable for you? Can you afford the proposed payment? Will you still be able to afford the payments if your financial situation changes even slightly? How long will it take you to pay off the loan, or what is the term of the loan? How will this affect your monthly payments? Can you change the payment frequency to biweekly? This can help reduce the amount of interest you pay on that loan. Do you need a cosigner? Are you prepared to pay processing fees? How much are these fees and what are they for? And lastly, should you take insurance on the loan? Later in the presentation, we will cover the different kinds of insurances your financial institution may offer for your loan. Now that we have covered things to consider when applying for a loan, let's look at the different kinds of lending products you may apply for through your financial institution. There are different kinds of loans for the different types of borrower needs. Each type of loan may carry different rates and/or fees. Next, we will be discussing the differences among these 3 kinds of loans: the line of credit, also known as a credit line; personal loans, which can be used for consolidation, RRSP contributions, or a vehicle; and mortgages. First, we are going to take a look at lines of credit. A line of credit or credit line allows you to borrow money as you need it and is available to use at the borrower's discretion. The borrower only needs to pay interest on the money that is actually withdrawn or used from the line of credit. Some basic features of a line of credit are: they are revolving funds. This means that you can withdraw money from your line of credit as you need it, pay it back, and then withdraw it again if you need to. Some uses of a line of credit include travel emergency, delayed payroll, and overdraft for checks. However, these funds are not meant to be used to go on vacation or buy a car. A line of credit can be seen as an emergency fund to use until you are able to save money for those emergencies. No withdrawal means no interest due. If you do not use or go into your credit line, there is no minimum payment that you have to make. You only pay interest on the amounts that you've withdrawn. Please note, however, that some financial institutions do have a monthly fee associated with their line of credit called a standby fee. Be sure to ask this when applying for a line of credit to account for any required monthly payments. Your interest is calculated daily and charged monthly. Interest is due on the amount withdrawn from your line of credit for the number of days it is used. The best way you can use a credit line is to pay it back as soon as you have the funds to do so. Next, we are going to take a look at personal loans and the things to consider when applying for them. Interest rates. A personal loan you can have a fixed or a variable interest rate, and you want to ensure you get the one that will best suit your borrowing needs. A fixed rate will stay the same for the duration of your loan and is usually between 5% and 10%, depending on the type of loan and your credit rating. A variable loan is one in which the rate will change as prime lending rate changes. Installments or number payment frequency. The duration or term of your loan can vary greatly from 6 months to 7 years. However, how many installments or payments you make will be dependent on the selected term and payment frequency you and your lender decide will best work for your financial situation. The payment frequency you can choose from includes weekly, biweekly, twice a month, or monthly. Insurance. When you elect to add insurance to your loan, your lender will present you with different options. You will have the option to insure your loan against death, disability, critical illness, and loss of employment. Every financial institution offers differing insurances, so be sure to speak to your lender to discover which option will best suit your needs. Earlier in the presentation, consolidation loans were brought up. We are now going to dive deeper into what a consolidation loan is. A debt consolidation or consolidation loan is a single loan, generally from a financial institution, that allows you to repay your debts to several or all of your creditors at once. You, as borrower, are then left with only one outstanding loan. This, in essence, allows you to bring together all of your debt under one monthly payment and one interest rate. If you find yourself in a tough financial situation, and no judgment, it may be a good idea to consider using a consolidation loan to bring together or blend many loans and debts into one easy-to-manage loan payment. Doing this allows you to pay off high-interest credit cards, loans, and lines of credit. You can simplify your monthly obligations, one bill with one interest instead of many, and you pay a lot less in interest with a better interest rate than credit cards offer. To get this kind of loan, you will need to apply for one from your financial institution. The steps are the same as applying for a regular loan. You inquire at your financial institution, book an appointment, bring all your credit card statements and other loan statements to share, as this will help in assessing if consolidation loan is right for you. On our next couple of slides, we are going to look at how consolidation loans can assist by first comparing different interest rates and then by comparing different terms for the same amount of money borrowed. This slide demonstrates the advantage of a consolidation loan in the amount of $10,000. While there may be some social stigma attached to consolidation loans, but this shows they are an effective way to save money over time by bringing all your financial obligations into one single loan. First, we see the interest of the loan is half of that being paid on the credit cards. The borrower is able to pick a payoff period that was 5 months shorter while maintaining the same monthly payment. This consolidation loan allowed the borrower to save almost $1,800 in interest. When looking at this, I want to ensure you are aware that this is a typical and realistic example. Consolidation loans really can help those experiencing financial hardships due to their debt. We just looked at how changing the interest rate by consolidation can save you money and cut down on the amount of time it takes to pay off your debt. We are now going to look at how changing your amortization, or the amount of time you choose to pay off your loan, can also affect the amount you pay in interest. As this slide shows, a $10,000 loan with a 19.99% interest each year you cut off in your amortization, so the amount of time you're going to pay off your loan, will save you over $1,000 in interest. So if we look between the 4-year and the 3-year amortization periods, your monthly payment will increase by less than $70, but you save $1,200 in interest. That's some big savings. What makes a mortgage different than other personal loans is the fact that it is a loan that is used to purchase a primary residence or residential property. Although they are similar to other loans that we have discussed thus far, they are different in two key ways. First, the size. Compared to other loans, which may be a few $1,000s, mortgages are usually hundreds of thousands of dollars. And secondly, amortization, or the length of time it takes to pay off your loan. Mortgages are usually stretched over long periods of time, anywhere from 10 to 25 years. It is important to note that not all mortgages are the same. You should find the one that is best for your borrowing needs and the one you will be able to afford. We will now examine some aspects of a mortgage. First, the down payment. How much money do you need to have saved up to pay up front for your mortgage? 20% is standard and known as a conventional mortgage. If you have less than 20%, there is an additional premium for default insurance. Interest rates, fixed or variable. You will have the option for your mortgage to choose either a fixed or variable rate. If you select a fixed rate, the interest rate will stay the same for the duration of the term, usually anywhere from 1 to 5 years. Variable rates have the potential of moving up and down depending on the Bank of Canada's overnight lending rate. This is called prime, plus or minus the amount your financial institution is offering. Type of contract, open or closed. How many years are you committing to pay this interest rate for? Open mortgages have no penalty if you break the contract to sell or refinance your property. In an open mortgage, your interest rate is usually higher than a closed because you are paying for the privilege to be able to pay off your mortgage at any time. A closed mortgage means you agree to pay the interest rate on your contract for a set period of time, usually ranging from 1 to 5 years. Closing costs. What fees and costs are associated with purchasing or selling your home? Home inspections, appraisal fees, legal fees, and property transfer tax are all additional fees you should have set aside when looking to purchase a home. Cost of ownership. What are the cost obligations of owning a home? In addition to having your mortgage payment, other costs associated with home ownership are property tax, maintenance fees, and home or fire insurance. When it comes to your mortgage, whether it is better to make large or small payments depend entirely on the borrower's situation. For some borrowers, paying smaller amounts over a longer period will mean that they can afford their mortgage and not stress over monthly bills, while others paying a larger amount over a shorter period of time is more desirable. Neither is right or wrong, just what suits the borrower best. On the graph, you can see it demonstrates how interest payments on a $500,000 mortgage can change depending on the interest rate and the term of the mortgage. We are going to take a deeper look at what we see on the mortgage earnings of a 4% interest rate over 15, 20, and 25 years. Over 15 years, it will cost $166,000 in interest payments, $227,000 in interest over 20 years, and $292,000 in interest over 25 years. The length of your mortgage determines how much you will pay in interest over the duration of your mortgage. Your monthly payments will also be affected by the interest rate you are paying. We see this difference illustrated on the 15-year mortgages and the difference in interest paid based on interest rate. At 2%, it's $80,000. At 3%, it's $122,000. And at 5%, it is $212,000 in interest. This chart demonstrates how varied mortgages are and how important it is to shop for the appropriate mortgage based on your borrowing needs and financial situation. No matter what kind of loan you are going for, before ever signing a loan agreement, make sure you understand all the terms and conditions of the agreement. A loan agreement is a legally binding contract, so if something isn't clear, ask questions. Your lender is there to help you understand the terms and conditions, but it is your responsibility to make sure you understand what it is you are agreeing to. So ask the questions. Some questions to ask are, what is the interest rate? Financial institutions sometimes have discretion in setting interest rates based on post-it rates and your risk as a borrower. Shop around to find the best rate. 2, how is the interest calculated? 3, what are the differences if I pay bi-weekly, twice a month, or monthly? Your payments will be calculated by the lender when you sign a loan. Be sure to have the lender explain the value in paying your loan, whether weekly or bi-weekly, instead of monthly, to save interest and shorten your loan period. What are the fees for making prepayments? Are lump sum payments possible? What are the fees? This is more common with mortgages, so be sure to ask this question when signing your mortgage documents. As a financial consumer, you have specific rights related to your personal loans, mortgages, and lines of credit. For the most accurate information regarding your rights, it's best to consult the Financial Consumer Agency of Canada. For now, keep in mind some of the following things. Your financial institution must provide you with accurate posting of payments, refunds, and rebates. If you are pre-approved for a mortgage, you can lock in an interest rate. This means they must guarantee your interest rate for a set period of time. This time can vary from 60 to 120 days. Your mortgage agreement states your financial institution must provide you with renewal statement at least 21 days before the end of your existing term. Also note that you are not obligated to renew your mortgage with the same institution or accept as is the renewal they offer. If you are thinking of switching institutions, you should start your search about 4 months out to give yourself time to do the research. If you are turned down for credit, regardless on the reason, being turned down doesn't have to be the end of your story. There are still things you can do, and indeed should do. Ask why your loan was denied. A creditor may make a decision to turn you down for credit based on a variety of reasons. It is your right to know why your application was denied. Get your credit report. If part of the reason your application is being turned down is based on your credit report, you can contact the credit bureau, either Equifax or TransUnion, and request a copy for verification that all information is reporting properly. Consider a cosigner. Having a cosigner with a good credit rating may provide the financial institution with assurance that they will be repaid. So consider asking someone you are close to and has a good credit rating if they would co-sign a loan with you. Consider a lower loan amount or a longer repayment period. If you can get a loan for a lower amount, carefully consider if it will be a benefit to you or if it will cause more financial trouble in the future. If you were to extend the repayment period, will this help you now but hurt you down the road is another aspect to consider. In today's workshop, we went over how to decide what kind of loan is best for your needs, how to understand your payment terms and obligations, and how interest is calculated and why it matters. Up on the screen, you will also find a link to a website that overviews your rights and responsibilities. So please take time to visit this page should you want to learn more. I would like to thank you for taking the time to join me today, and we hope to see you next time.